A stock chart climbing up and to the right. That's a good chart, right? But in pairs trading, if this line trends anywhere, you've already lost. The pair is broken. The line you actually want goes nowhere. It just breathes around zero. That boring line, the spread, is the whole strategy. Last episode, we settled one thing. Two stocks with different prices and different volatility. We put them on the same ruler. The normalized price index, a mean of 0, a volatility of 1, and with that, we could finally see how alike two stocks really move. But look, moving alike is still two lines. You lay them on top of each other and hunt for the spot where they pull apart. Today we make that much simpler. We take those two lines and we fold them into one. That single line is the pairs trading spread. The method is a single subtraction. You take one stock's normalized index, and you subtract the other stock's normalized index from it. Take Coca-Cola's normalized line, subtract Pepsi's normalized line, and the two lines become one. We'll call that single line the normalized spread. One honest note here. Normalized spread isn't a formal textbook term. I'm using it to keep it separate from the log spread we'll meet later. The word spread just means the difference between two prices, and in pairs trading we use it to mean how far the two have pulled apart. Reading this line is easy. When it drops below 0, Coca-Cola is relatively cheap versus Pepsi. When it climbs above 0, Coca-Cola is relatively expensive. And this line never sits still. It stretches away from 0, snaps back, stretches again. It oscillates. So how do you trade off this one line? Look at the A zone, where the spread has dropped far below 0. Coca-Cola has gotten cheap relative to Pepsi. So what do? You buy the cheap Coca-Cola and at the same time, sell the expensive Pepsi. Selling means shorting, borrowing the shares to sell. Then, when the spread snaps back near 0, you close both sides. And the B zone, where the spread has spiked far above 0, you just flip it. This time you sell Coca-Cola and buy Pepsi, and again, you close as it returns to 0. Here's the point. You did not bet that Coca-Cola goes up or that Pepsi goes down. You bet that the gap between them narrows again. You're not calling direction, you're harvesting the round trip of the gap. Now the most important question. Subtract any two stocks at random. Do you get this pretty oscillation? No, a good spread has conditions. 4 of them. And this is the answer to the riddle I opened with. 1, it must have no trend. If the spread drifts one direction, up or down, and keeps going, you picked the wrong pair. This may be the single most important feature. A series with a trend is very hard to predict or act on. But a series with no trend, one that keeps returning to its mean, is far easier to work with. That is why we want the boring flat line. 2, it must stretch away from the mean and pull back over and over. A repeating cyclical pattern around the center. If it pulls apart and simply stays there again, wrong pair. 3, the cycle can't be too long and can't be too short. Too long, say it takes a full year to close, and the cost of holding that short position piles up and eats your profit. Push it far enough, and you'd have been better off just leaving the money in the bank earning interest. It becomes a loss. Too short, closing in a day or two, and the risk is high and the timing is nearly impossible to catch. 4, the spread should be spread out roughly like a normal distribution, most of its time near the mean, only rarely far out at the edges. That's the easiest kind of spread to trade. The normalized spread is an excellent tool for seeing the gap with your eyes. It's intuitive, but let me be straight with you about its limits. There are 3. 1, this spread is computed from the mean and standard deviation over the entire period, so past data weighs too heavily on today's value. 2, it doesn't reflect actual returns well. The spread can move the same distance, yet the money you actually make comes out a little different each time. And 3, the important one, this spread never tells you how many shares of Coca-Cola to buy and how many shares of Pepsi to sell. It gives you no position size. The tool that fixes all 3 of these is the log spread, and that's next episode. So, can you build this spread yourself? It's surprisingly simple. No expensive system, no heavy math required. One quick bit of context first. If an exchange lists 1,000 stocks, the number of possible pairs is about 500,000. Searching all of those does take a computer, but the calculation for any one candidate is simple enough to do by hand. Let's draw it out with Home Depot and Lowe's. two stocks in the same home improvement business. Here's how it's drawn. First, you lay the two stocks' price paths side by side, but as we saw in part 2, their prices and their volatility differ, so you can't compare them as is. So you put each one on the same ruler, you normalize it to a mean of 0 and a volatility of 1. The only ingredients you need are two, the average and the standard deviation. Then you take the two normalized lines and subtract one from the other, and out comes that single spread line from before. Finally, you lay one smooth trend line over the top, a 10-day moving average, and the flow reads even more clearly. That's all there is to it. An average, a standard deviation, and a subtraction. Those are the only three ingredients. So you don't need an expensive platform. A simple spreadsheet is enough for you to drop in any two stocks you're curious about and see for yourself whether the line comes back to 0 or drifts off in one direction. Let me bring it together. The normalized spread turns two stocks into a single line that mean reverts around 0. And a good pair's spread is boring. No trend, always pulling back to the mean, spread out close to a normal distribution. You can build that line with nothing more than a spreadsheet. But remember its limits. This spread won't tell you your position size, and it won't give you a precise return. So next episode, we go one level deeper. The log spread, the tool that finally answers size and returns. That's where this gets a lot closer to the real thing. One last thing, and I mean it. Today was about how the normalized spread works. It is not financial advice. The final call is always yours. If this helped, please like and subscribe. And in the comments, tell me, which two stocks would you run through the spread first? I'll see you in the next one.